So you've heard talk about Roth conversions, but you have no idea what they are or if you should even do one. Hi, I'm Garrett Ray, financial planner here at the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to cover Roths versus IRAs. We're going to talk about the differences between them. We're going to talk about the difference between a contribution and a conversion. A lot of people get those two things mixed up. We're going to talk about the 5-year rule and distribution rules. And we're also going to talk about when, in general terms, it might make the most sense for you to do a Roth to IRA conversion. Don't forget to hit these like and subscribe buttons down below us if you want to catch future episodes. Let's go ahead and get started on it. Now, the first thing that I want to impart on you all is we are not giving advice here. We know nothing about your situation, and it would be foolish for us to tell you that you should be doing a Roth conversion. Let's just assume, for the sake of this, that Roth conversions do not make sense for you and you should not do them. All we're doing here is wanting to give you information so that when you hear people talk about Roth conversions, you know what it is they're talking about. Get help, get advice from a true financial professional, and they will help you understand if you should do a Roth conversion, when, what years, all at once, little by little, those kind of things. But we just want to give you information here. So Garrett, let's go ahead and get started on the very basics here.
Okay.
2 different types of accounts that are out there,
right,
aside from your basic brokerage account, non-qualified accounts.
Okay.
We've got IRA accounts, which people are generally familiar with, same as 401ks.
Yep.
And then we've got Roth accounts. For somebody who doesn't even understand the difference between those two things, let's start there.
Okay, so let's talk about the main differences. Traditional IRA, let's talk about kind of the good of it. When you contribute to a traditional IRA, the following year, when you file taxes, so this year is 2023, I'm contributing to my traditional IRA. When I file for 2023's taxes, my contributions up to $6,500 if you're age 50 or below, and then you get an extra $1,000 if you're above age 50, so now $7,500. You can deduct that from your income when you file taxes. So you get, that's called tax deferred. The opposite is true of a Roth. So you do not get to deduct it from your taxes, your contributions from your taxes. But the difference is that when you eventually take the money out of the account in the form of a distribution, that growth and that money comes out tax-free. In a traditional IRA, it is taxed at your income level. So that's the difference there.
And so an IRA, just to be clear, you're not paying taxes on it in the year that you're making the contribution,
right,
end result anyway. But 20 years later, when you want to take a distribution from your IRA, maybe it's grown from that 6,500 to
right,
20,000 or whatever. Right. You're going to have to pay taxes on 100% of what you take out then.
Yep.
And ideally, you would be in a lower tax bracket then, but
right,
that oftentimes doesn't end up being the case.
Not
so you're
always the
deferring
case.
Your taxes until a later point is the point of an IRA.
Right.
But a Roth, when that account grows from the 6,500 to 20,000, you don't have to pay any taxes.
You've already paid them.
You've already paid them. Yep. So you're paying, basically, as your dad likes to say, Doug Ray, founder and principal of the Wealth Guardians, he likes to say, would you rather pay tax on the seed or on the harvest? Well, most people would rather pay tax on the seed. Yep. That's the idea of paying taxes on a Roth up front and never having to pay taxes on it ever again.
Exactly.
And we're going to help you understand why that basically makes some sense here going forward. All right, so you started to touch on it, but let's talk about contribution limits. As you said,
yep,
in an IRA, and this is true for a Roth as well.
Yep, same.
6,500, this is year 2023. So 6,500 is your contribution limit for those who are under 50 years old.
Correct.
But once you are over 50 years old or 50 or older, Now they have a catch-up rule, meaning that, well, the government, the IRS thinks you might have gotten behind on contributing to your retirement funds, so they want to give you a little bit of a ability to contribute more at that stage. So in 401ks and IRAs and Roths and SEP IRAs, they let you contribute a little bit more at that stage. So if you're 50 or over, in the year 2023, they always up this a little bit every year. You're allowed to contribute $7,500.
Yep.
Now that's a contribution.
That's a contribution.
Now let's talk about what is a conversion and what are the limits for conversions.
Right. So we talked about there's limits on contributions, whether that's 6,500 or 7,500. When we're talking about conversion, and you're talking about converting money from a traditional IRA classification to a Roth IRA classification, there technically is no limit on how much you can convert. But when you do the conversion, whether that's $1,000 or $100,000, in that tax year, you have to claim that as income and pay taxes on that. So you can see if you do a very large amount, plus you have earned income, well, you could bump yourself really high into a very high income tax bracket.
That's right. So I was looking at the numbers earlier. You could be a joint couple who has minimal income. Maybe you're retired, you have minimal income, and you're falling in the 12% tax bracket. Maybe with all your income levels, you're at $75,000. If you did a $100,000 conversion, and that put you in the 12% tax bracket, if you do a $100,000 conversion in 1 year,
right,
that kicks you up from the 12% tax bracket through all the way through the 22% tax bracket and into the 24% tax bracket. So for most people, they would not want to do a huge conversion all at one time.
Right.
It's about pacing yourself. So what you generally want to do is take a look at, based on all of your income for that year, where do you fall in your tax bracket and how much could you add to your taxes for that year, bumping yourself up to the very top limit of that tier that you're in.
Right.
So if the 12% tax bracket goes up to, say, $85,000 and you had $75,000 of income, you could do $10,000 of an IRA to Roth conversion that year. That's a taxable hit that year, but now you've started opening that Roth pool for yourself.
Right.
And we're going to talk about the 5-year rule here in just a moment. But now that money grows tax-free. So it's not a matter of, is there a conversion limit per se by IRS rules? It's a matter of, is there a limit that makes sense for me?
Yeah.
And do I want to go beyond that? So
yeah, what
no,
amount of
you
conversion is palatable?
Right. And so that's really where you want to get a financial planner on your side, because we have the tools and the ability to not just look at this year, but forecast ahead 1, 2, 3, even 10, 20 years and help identify, based on all the knowns and the assumptions we have to make, where are those sweet spot years?
Right.
Well, a sweet spot year might be, maybe you retire at age 65, but you're not planning on filing your Social Security until age 70. Well, that's what we call the gap years in the financial world. And that's generally where you fall down a tax tier for a couple of years. That might be the prime sweet spot for you to do for a couple of years, pace out that conversion. Instead of doing 100,000 all at one time, do a little bit for a couple of years. But there is no, as we said, there is no limit to a conversion.
Right.
Okay. Now, we did another Vault episode a few weeks back on all the complexities of Roth distributions. That link for that is right here. So if you want to go and watch that one when you're done here, highly recommend it. But let's talk about now the 5-year rule, Garrett, with Roths, because there is no other account that this is applicable to.
Right.
People hear about SEP accounts, they hear about 401ks, 403bs, 457s, TSP accounts, cash balance plans. There is no other account out there that has this 5-year rule. So this is very unique to Roths. Garrett, what is the 5-year rule?
So essentially, when you put money into a Roth account, it effectively has to cure for 5 years until that money is able to be taken out tax-free. So the assumption is that you're going to start the Roth earlier in life and then allow those monies to sit for 5 years. Once they sit for 5 years, then indeed they truly are tax-free and you can start taking them out then.
Right. So somebody might think, well, I've got two Roths out there. I've got this one that opened a couple of years ago, and I've got this one that I just opened now. If you've got them separated, then each one of those has to stay open for 5 years before you can take a distribution of the growth of those accounts.
Right.
You're always allowed to take a distribution from the money that you put in there. So if you put $1,000 in and it grows to $1,010, you're allowed to take that $1,000 out whenever you want to. It's that $10 that you can't touch, or else the IRS is going to come swat you on the hand.
Right.
But again, watch that other video of ours. By the way, in that video, I do reference that Roth accounts started in the 1980s. I knew that wasn't right at the time. It started around 1997. I'm clarifying that now, so when you watch the other video, I do know when Roth started. I just had a brain freeze for a moment. All right, so Garrett, now let's talk about when would somebody do a Roth conversion? Would they do it when they're in a high tax bracket?
No, and you touched on this earlier. So if you really wouldn't want to do a conversion when, let's say you're I can imagine someone who's kind of at the peak of their career in their late 50s, early 60s, making a decent income. You probably would not want to do a conversion of any sizable amount from a traditional IRA into a Roth, because you're already earning a very healthy income. And if you do that conversion, remember, you have to, whatever that conversion amount is, whether it's $1,000 or $100,000, you basically have to add that number onto earned income already.
Right.
So it could bump you really high up into your tax income bracket.
And that's what we're trying to avoid.
Yeah. So a sweet spot, as Brice was talking about, would be, let's say you do retire the job at age 62, 65, but you don't plan to file for Social Security for several years. You're living off of either your savings or your investments. Well, at that point, your earned income has really, really fallen. Then you could do a conversion at much lower tax bracket rates, and that makes a lot more sense for most people.
Exactly. All right. So as we financial professionals tend to have, we have a lot of calculators at our disposal. So I have got a Roth versus traditional IRA printout here. I just want to give you the basic numbers here so you can understand what kind of difference doing an IRA to a Roth conversion might help you out at. Let's say we've got somebody, we'll call him Joe Client. He's currently in the 12% tax bracket. He believes that in the future, he's going to be in the 20% tax bracket, either because of his income or because he believes just taxes are going to go up.
Yep.
He's going to do a Roth conversion of $100,000. Now, he's not going to do it all in 1 year. He's going to do it so he's paying 12% tax on the entire thing over the years. But he's going to pay the taxes not out of the IRA when it converts over to the Roth. He's going to let 100% go into the Roth, but he's going to pay the taxes from another account over here, a brokerage account over here, a non-qualified, an individual account. And he's going to take a tax hit on that account of 15% for capital gains. Doing a $100,000 conversion, and by the way, the rate of return that we're assuming on this for the next 30 years on both accounts, the IRA or the Roth, is a simple 5%. Let's not get greedy here. At the end of that 30 years, if he did the $100,000 conversion, at the end of the 30 years, his $100,000 would be valued at $432,000. But if he never did the IRA to Roth conversion and just kept it in the IRA, the amount after he would have to pay the 20% in taxes is $387,000. So that's a difference of $44,600 simply for doing something that in the end never cost him a dime to do. Now, he had to pay taxes on it earlier than later, but there wasn't a cost for him to do that. Does that make sense? So that's the difference that doing an IRA to a Roth conversion can have for somebody, just with these simple assumptions here. But again, not giving advice here, just letting you know what this world of Roth conversions is. Go talk to your financial professional. We're financial professionals. If you want to reach out to us, we'd be happy to talk to you. But that covers this episode of The Vault and what we wanted to talk about. Garrett, anything else you want to add there?
I think you covered it, Brice.
All right. That's going to wrap it up for this episode of The Vault. Feel free again to hit these like and subscribe buttons if you're so inclined. I'm Brice Payne.
And I'm Garrett Ray.
And this has been The Vault.